All right, well, let me begin the meeting. Welcome to the Research Triangle chapter of AAII. My name is David Drake, and I am the new president of the chapter. Due to the pandemic, AAII does not allow chapters or special interest groups, such as our income and option SIGs, to meet in person. At some point, though, AAII will allow in-person meetings, at which point we plan to hold meetings again in person. Right now, the guidance AAII is giving us is maybe for January of 2022, but this is certainly subject to change. I am the new president of the chapter. I am taking the place, trying to fill the shoes of Bill Terrell, who for many years has tirelessly led our chapter. He was program chair and then promoted to president. And then as like Nico Medina left, he then became program chair and president. And during the pandemic, that really was a lot of work. And he worked tirelessly to make the chapter work. So many, many thanks to Bill and his tireless efforts. Because Bill has stepped down, we've had to shuffle responsibilities on the board. I was treasurer and now have become president. John Lentz has been our librarian and he is now our treasurer. But it does leave some void on our board, and we would love if you could volunteer to help. As the saying goes, many hands make light work. We need a vice president who traditionally is responsible for procuring facilities, helping with AV, audiovisual needs for meetings, that kind of thing. We need a librarian, certainly, since John cannot be collecting money and manning the library at the same time. A marketer, we'd love to grow our chapter attendance because that helps to defray the costs to everybody and we keep the costs low. We are considering broadcasting our in-person meetings when we start to meet again so that people can continue to enjoy webinar style meetings for those who either are sick or can't travel for whatever reason. So we'd love to line up a videographer perhaps to make that happen. So we do need volunteers. We're a collegial bunch. We don't bite. We'd love to have you on board and working with a great group of people. One of the people who has volunteered is Carl Broadhurst. He is our new program chair. His background is that he worked for the Army Finance Corps and he was a colonel there. After he retired from the Army, he was an associate business professor at Mount Olive University and then at Campbell University, where he also served as associate dean. So we really appreciate Carl stepping up and doing perhaps the most important job of the chapter, and that is the program chair, who is responsible for finding and coordinating speakers for our monthly meetings. So thank you very much, Carl. And with that, I will turn it over to you.
Good morning, David and Alan, and thank you. By the way, I see a question today. AAII rescind their decision to get rid of local chapters. I could talk a long time about that, or I could say yes, and that's the current status right now. Alan, thank you for being here today. By the way, Bill Terrell, I assume you're listening today and watching. I will say this, you made it look pretty easy doing what David and I now together are doing and doing it all by yourself. As I said, Alan, thank you for being here. Alan's the president of the Blue Collar Investor Corporation. He's authored several books on the subject of covered call writing. And as a matter of fact, one of those books is on Amazon's top position for option and has been for several years. He has another book called Stock Investing for Students, and the University of Maryland makes that required reading for his students, for those students there. He's been a frequent guest on several financial programs. Nationally, he's spoken for the Money Show, Stock Traders Expo, and also AAII. And he has spoken to several AAII chapters throughout the country over the years. He still wears many hats, one that he used to wear. He is a retired general dentist, no longer doing root canals, find covered call writing apparently much more to his liking. He's a licensed real estate salesperson. He's a certified personal trainer, and he's successfully completed Series 65 requirements. His desire is to educate the average retail investor on how they become the CEO of their own money using his favorite strategy of covered call writing and put selling. Particularly for today's presentation, he's got a helper called Barry. So some of you folks are asking questions already, and I suppose I really should say using the chat icon. So the Q&A is disabled, but chat is there. And so use your chat as you wish. His helper Barry will be answering those questions, responding to you in real time. Alan, thank you for being here today, and the microphone and the screen is yours, sir.
Okay, let me get my PowerPoint up. Okay, does that look okay?
Look great on my screen, Alan.
Okay, thank you very much, gentlemen. I appreciate it. Welcome, everybody, to my presentation today. The title of my presentation, because we're going to be discussing my two go-to strategies, which is covered call writing and selling cash secured puts. We're going to combine those into one multi-tiered option selling strategy, which in the BCI methodology, we refer to that as the PCP, or put call put strategy. Outside the BCI community, it's known as the wheel strategy in a lot of venues. So we're going to be showing the advantage of mastering both strategies, but we will be first taking covered call writing, then going through selling cash secured puts, and then combining the two strategies. Now, as Carl mentioned, Barry Bergman, BCI Managing Director, is here to respond to your questions in real time via the chat box. So please feel free to take advantage of Barry. And at the end of the presentation, if there are any questions left over, I'll be happy to respond to them. Now, this is the slide you're all used to seeing at the beginning of a presentation. Basically, in my mind, what this means is that whatever trades that you see relating to option selling were appropriate at the time that I executed them, may or may not be now. So take this information for educational purposes only and not as specific recommendations. Let me give you an overview as to how we're going to proceed with this webinar over the next hour or so. We're going to discuss the 3 required skills for option selling. And those of you that are members of the Blue Collar Investor or have heard me speak or read my books, you know that I really emphasize this, that before you risk even 1 penny of your hard-earned money, you should have mastered these 3 skill sets. So we'll get into that. We're going to then move into a preview example for both covered call writing and selling cash secured puts, just to lay the foundation for a real life trade with T-Mobile that we're going to be using actual option chains, actual calculations at the time that these trades were executed. I'm also going to talk to you as part of the presentation. I'm going to stop and just for a moment or two and talk to you about how you could use put options instead of limit orders, because frequently, look, everybody likes a discount, and frequently there'll be a stock that we like, and we tell our broker, you know, I'd like to buy that stock. If it goes down in value, I want you to buy it for me. So you put a limit order to buy that stock at a lower price than it's currently trading for. Now, if the price of the stock does in fact go down to that limit order price, then the trade will be executed and you will receive those shares at your target price. But if it does not go down to that price, the cash that you set aside with that limit order has done absolutely nothing for you. I'm going to show you another way to approach this situation, selling put options. I think you're really going to like this. We're going to do calculations for both the call side of the trade and the put side, and then show you the combined call put calculations in terms of the downside protection that you're going to receive if you integrate these two strategies into one multi-tiered option selling strategy. And I think you're going to be impressed with the possibilities for those of us that are concerned about volatile markets or bear markets or whatever people are concerned about, which is all the time. Everybody's worried about everything all the time. So this will show you how to give yourself that additional downside protection that may help you sleep better at night. At the very, very end, I'm going to talk to you about our BCI package, which is an acronym for our best and most comprehensive investment package ever offered by the blue collar investor. So it's, if you want to get everything you need to master both strategies, and you'll see what's involved in the package. If you want to get everything in one package, it's discounted, and we're going to offer this AAI group, which we always do whenever we do a group discount for AAII, an additional discount of $100 on top of that. So we're only going to get to that in the last 3 or 4 minutes. This is going to be a didactic, content-oriented presentation. Once again, questions will be answered in real time by Barry. At the end, if there's any questions left over, I'm happy to stay. And then I'm going to give you my email address and Barry's email address if you think of a question later on and you'd like to send it over to us. Okay, let's blast off now. So what are the 3 required skill sets essential for option selling? And when I say for option selling, I'm talking about successful option selling where you can achieve the highest possible returns. So the first required skill is, what stock or exchange traded fund are we going to select? Now, I could tell you right off the bat that a lot of investors will select underlying securities that will generate the highest option returns, more money. However, more money means more risk. And covered call writing and selling cash secured puts are conservative, low risk option strategies geared to the retail investor, although a lot of professionals more and more are starting to use these strategies. So it really doesn't make sense for most retail investors to use highly volatile stocks that generate higher premiums. So that's something that is important when we're selecting the underlying security. Is it too volatile? Is it just right for us? But they have to be fundamentally sound. That's step number 1. And I'm talking there about sales and earnings growth. So the reason that's so important to me, and this has been borne out for me personally and for thousands of members of the blue collar investor, because the institutional investors love securities that are fundamentally sound. So I'm referring now to mutual funds, hedge funds, banks, insurance companies, the guys that move the market, the guys that are responsible for 70% or higher of market movement, not us, retail investors. They love stocks that are fundamentally sound. And if they love them, you know what? So do I. So that's step number 1, screening for stocks that are elite performers from a fundamental perspective. The second step, and I'm going to show you a chart on a bullish technical chart, is looking at a price chart. So many of you probably know how to read a price chart. Probably a lot of you never looked at a price chart before. And when you first look at it, it can be very intimidating. But if you could tell if a line is going up or down, or if it's above or below 0, then you have the skill set to read a price chart. It's that simple. Now, I use 4 particular parameters. I will name them for you coming up. That really will show you the trend. Is the price moving up, down, sideways? momentum, and we measure it against volume. So I use 4 parameters. I'll show you what a chart looks like the way we screen it. That does not mean you must use the same 4 parameters that I use. If you have ones that you particularly like, great. You know, what you're comfortable with is what you should use. But in my opinion, it should involve trend, momentum, and volume. Now, once we have screened for that, we also look at things I call common sense principles that don't fit into the first 2 groups. Things like minimum trading volume, avoiding earnings reports, which is very important for short-term option selling, diversification, asset allocation. So those kind of things. So we put our securities through a rigorous set of screens that fall into one of these 3 categories. And I'll show you what just the top part of one of our reports looks like, so you can get an idea of the screens that we put our securities through before we end up with our watch list each week. Now, that is the first required skill. Now we move on to the second one. Once we have the underlying security, what option are we going to select? That means what strike price are we agreeing to either sell our shares for, in the case of covered call writing, or buy the shares in the case of selling cash secured puts. So the strike price is important. And then what contract expiration date should we select? Now, I'm going to let you know that I favor 1-month expirations. So the contracts that I sell expire on the 3rd Friday of the calendar month, 4 p.m. Eastern time. We have many members of the blue collar investor that like to use weekly options that expire every Friday, 4 p.m. Eastern time. Now, you can make money with both. What I would ask you to avoid are long-term options, because first of all, I'll give you 2 reasons without going into too much detail, because it's slightly beyond the scope of this webinar. But number 1, using longer term options will get you a lot of money quickly, but if you annualize the returns of weeklies and monthlies versus longer term options, the annualized returns for the longer options will be lower. Second important reason is that it'll bring you through multiple earnings reports, which is one of the most important rules in the BCI methodology, is to avoid the risk of an earnings report. I'm sure many of you have owned shares of stock that are doing just great. Then the earnings report comes out and it disappoints, and wow, you're really taking a bad hit. So for low risk option selling strategies, where capital preservation is critical, we just avoid the earnings report, period. And so that's why longer term, another reason why longer term options are avoided. So that's the second required skill. And then the third one is, how do we manage our positions once we've entered the trade? So regarding covered call writing, a lot of investors may know, okay, I got it down, what stock to select. I got it. And I also got it on what option to select. You know, if I'm more bullish, I'm going to go with an out of the money covered call. If I'm more defensive, I'm going to go with an in the money covered call. But they don't know what to do if something goes wrong during that trade. They don't know how to manage their positions. So that then becomes the third required skill set, position management, that you must master, all 3, before, as I said before, risking even 1 penny of your hard-earned money. And to those of you out there that are just starting out, you may know a little bit about options, but not that much. Maybe you know nothing about options. You know, somebody mentioned it to you. I think I'll listen to Al and see what's going on. I'm going to tell you that it won't take you that long to master these 3 required skills. The average retail investor needs about 3 to 4 months of education and practice paper trade to then get ready to start your option selling career. So what I'm telling you here is that as you listen to my presentation this morning, even if you think when I'm done that I did a pretty good job, and you're just kind of starting out, you're really not ready to sell options on Monday. You know, give yourself a chance to learn the pitfalls, the risks, the pros, the cons, master the 3 required skills, then you've got years and decades to benefit. Now, I told you that I was going to show you a bullish technical chart here. So this is a technical chart for applied materials, and I'm going to start at the top now. So you could see here on the top, we have 2 lines, a red line and a blue line. Now, this is known as an exponential moving average. So a moving average is when you add up price points, usually closing price points, and divide by the number of days. And so in the case of this chart, the blue line represents 20 days and the red line represents 100 days. Now, if I were to ask you, would you like to see the price of a stock stronger more recently, the 20-day EMA blue line, or in the longer term 100-day EMA, the red line? You would probably say, well, it'd be more important that the recent prices are stronger. And so we would want to see that blue line higher than the red line, which we do here. So the difference between a simple moving average and an exponential moving average is that the more recent prices are weighted more heavily in an exponential moving average. And for short-term option selling, that's very important. So we want to see that line moving quicker since we are taking on a short-term trading obligation, a week, maybe a month. So that's the reason I selected exponential moving averages. So at the top part of this chart, what we want to see is the blue line higher than the red line. That's not so hard. We want to see the price bars or candlesticks, whatever you prefer, at or above that 20-day EMA blue line, which it is in this case. So it takes about a second to say, as far as the moving average or trend is concerned, this is right now a bullish signal for applied materials. Let's go to the middle of the chart now, and we're going to look at something called the MACD histogram. Big fancy word. All you really have to know is it's those blue bars. And what we're looking for in those blue bars is we'd like to see them above 0. That's a bullish signal. So the MACD histogram is also a trend identifying indicator, but also a momentum indicator. And without getting into the formulas and everything, it tells us trend and momentum, and above 0 is good. Below 0 is bad. So when you look at this price chart in a second, you could say the MACD histogram is right now for applied materials a bullish signal. Now let's go down to this is a momentum indicator called the stochastic oscillator. And it tells you where the price of that stock is in relationship to the price of the stock range in the last 14 trading days. We'd like to see that ascending. Now, there are certain parameters that show extremely bullish and bearish, and I'm not going to get into those details, but suffice it to say, we'd like to see that ascending as well. And you could see here that the dark black line in the bottom third of the screenshot is in fact ascending. And finally, we want to look at the volume. These are 3 bullish technical signals. Is volume confirming that? In other words, is volume petering off where it's starting to trend down? No, it's not. It's actually holding very well. So all in all, if we did a mosaic of this particular screenshot here on applied materials, factoring in exponential moving average, MACD histogram, stochastic oscillator, and volume, we would say bullish price chart. And we would then say, based on the technicals, because we've already screened for the fundamentals, we're going to take a bullish stance on our covered call writing or selling cash secured put trades based on the technical screening. Now, there is another outstanding factor, and that's what's going on in the overall market that may sway us to take a more defensive position here. But just from a technical perspective, we would take a bullish approach. If we were covered call writing, we would go out of the money, and we'll get into that a little bit later. And for covered call writing, if we had a mixed chart rather than a bullish chart, we would go in the money. Now, this screenshot shows the very top of our stock report, and all of this all along the top in that blue bar here represent the fundamental screening, the technical screening, and the common sense screening that we do for our members on a weekly basis. And all the stocks that are in the white cells are eligible securities as long as the option liquidity is adequate. So the yes is it is adequate, no, it's not adequate. The reason we include some stocks that have inadequate option liquidity is because A, that could change, and B, we have members that use these screens just for buying and selling stock without the option component. So we want to make this information available for as many trading styles as possible. But that basically is the way we select our underlying securities before we even look at the option component of our trades. Now, when we get into strike selection, we have what we call the moneyness of an option. Strike could be in the money, could be at the money, could be out of the money. For purposes of this webinar, I created this screenshot just to show you bullish positions and then more defensive positions. So if you had a bullish technical chart and the overall market was normal to bullish, you would go with, as far as calls, you would go with out of the money strike. So an example of that would be a stock is trading at 48. We select the $50 call option out of the money, higher than current market value for calls. That will give us the opportunity to generate not only option premium on the sale of that call option, but also share appreciation from current market value 48 up to that $50 call strike. So the advantage of using an out of the money call option is that we give ourselves the opportunity to create two income streams in the same month with the same stock with the same investment, one from premium and the other from share appreciation. Now, looking at from the put side, a bullish position with selling a cash secured put, because in the BCI methodology, we only use out of the money puts. In the case of a put, that means lower than current market value, the opposite of calls. And we'll give you some examples. So if this is all new to you, relax, have another sip of your coffee. Don't worry. We're going to give you some examples that'll make this clearer if you're just starting out. But for puts, out of the money is lower than current market value. So we only use out of the money, but a bullish position, we would go closer to at the money. So if the stock is trading at 48, we would select the put strike lower than 48. But since we're bullish, we would select the strike that's close to the at the money 48 call. We might go 47 or 46 when we select that put strike if we're overall bullish on the chart technicals and on the overall market. Now let's move over to the right side of this screenshot. And we're going to take a more defensive position with both calls and puts. Now, if the chart is mixed, if we're concerned about the overall market, I know some of you are right now, and you want to take a more defensive position, you would then sell an in the money call strike. So if that stock was trading at 48, instead of selling the $50 out of the money call, we might sell the $45 strike in the money call, lower than current market value. Now that would then have an intrinsic value component to it of $3 because the stock price is $3 lower. The strike price rather is $3 lower than the current market value of the stock, 48. So the premium would include that $3 intrinsic value plus a time value component. Maybe we'll get $4.50 on that. And that means we're going to lower our break even more with the in the money call because of that intrinsic value component than we would for an at the money or out of the money call strike. So the takeaway here is that a defensive position for covered call writing would be an in the money call strike lower than current market value. Now, a more defensive position for the puts would use a deeper out of the money put strike. So when we sell a put, we're agreeing to buy the shares at a strike price. So if that stock was trading at 48 and we were bullish, we might consider the 47 or 46 out of the money strike, but close to at the money. But if we were concerned about the market, or if the technical chart was mixed as opposed to all bullish, we might want to take a more defensive position and go deeper out of the money or much lower than the current market value of 48. We might go down to the 44 or 43 strike, meaning that we're agreeing to buy the shares at a much, much lower price than current market value, giving ourselves that additional downside protection. So in order for that option to be exercised, that stock price would have to drop a whole lot before it would be, those shares would be put to us. And by the way, if we don't want those shares put to us, we can always buy back the option. But we're not going to get into detail on exit strategies because it's beyond the scope of this 1 hour presentation. So let me give you a preview example now for covered call writing, and then we'll do one for puts, and then we'll use a real life example and kind of combine the two. So in this hypothetical, we're going to purchase 100 shares of stock at $48 a share. Now, one option contract consists of 100 shares. So if we want to sell one covered call, we have to first buy 100 shares of stock in order to be covered or protected in our trade. Matter of fact, for most of us, our broker will require us to own the shares in order to allow us to sell the call option. If we don't own the shares, that would be naked option selling, and it's very risky, and most of us cannot get approval for that type of trading. All right, we buy 100 shares of XYZ, and we invest $4,800. That's our cost basis. Now we are covered or protected. Next, we sell the option. We're going to sell an out of the money option higher than current market value, or we're going to sell an in the money option lower than current market value. First one would be more aggressive. The second one would be more defensive. We're going to use 50 out of the money strike in this example, and we're going to use a 1 month expiration. Now we have paid a premium because we are undertaking a contract obligation. So let's use an average premium of $1.50 per share or $150 for the one contract. Now, sure, most of you are aware that the brokerages have removed commissions for the stock side of the trade. They're zero. And the option contracts run between 50 cents and 75 cents a contract. So we could pretty much take commissions out of the equation in terms of how it impacts our trade results. And I have in my calculation, so it's negligible. So we're going to get $150. Now, if the security was more volatile than this hypothetical one, we would get a higher premium and incur more risk in the trade. If it was less volatile, we'd get a lower premium and incur less risk in the trade. But 150 would represent a 3.1% 1 month return on a cost basis of $4,800, which annualizes out to 37%. Now, folks, this is the initial structuring of the trade. It does not mean it's the final results. The final results could be less and it could be more because we sold the out of the money call where we have an opportunity for share appreciation. Now, at the end of the 1 month, there were two possible major outcomes, and let me remind you, we're setting aside exit strategies here, okay? Because that will impact our trade results to a great extent. We're assuming no exit strategies. So at the end of the month, if the price of the stock is lower than 50, the option buyer is not going to say, let's exercise this option and buy Alan's share for 50 when they're trading at market at a lower price. That won't happen. So the option expires worthless. We keep the $150 and we still own the shares. So that represents a 3.1% 1 month profit, and we could sell another option for the next contract month. Now, the second possible major outcome is the price of the stock does in fact move above the agreed upon $50 sales price, and then our shares are purchased, assuming we don't buy back the option prior to 4 p.m. Eastern time on expiration Friday. We just let it ride. On Saturday, you log into your brokerage account and you say to yourself, hey, where'd my stock go? And then you look at your cash account and you go, hey, where did all this money come from? Well, you just sold 100 shares per contract at $50 a share. $5,000 per contract is added to the cash account. Now, in this particular case, in addition to the 150, we've also now made another 200 on the sale of the stock because we bought it at 48 and we sold it at 50. So our total profit for the month is $350, which represents a 7.3% 1-month return. And that annualizes out to that ridiculous number, 87% you see at the bottom of this screenshot. So let me state the obvious that you guys already know, and that is that you're not going to get this kind of return on every position in your portfolio every month of the year, right? You knew that already. However, I've been doing this for more than 2 decades now, since the mid-90s. You will get a few of these every month. So you have to know how and when to use this type of option strike, the out-of-the-money strike. You also have to know how to use the in-the-money. So that's that skill set that I talked about earlier, which is strike price selection. And by the way, all of that is detailed in the material I'm going to mention at the very end of this webinar. Okay, that was the preview example of covered call writing. We're going to do one now for selling cash secured puts. So remember, when we sell a put, we're obligated to buy the shares at the strike price by the expiration date. Now, let's assume a stock is trading at $75. We like it. We wouldn't mind otherwise owning this stock in our portfolio because the screening process has told us that it's an elite performer from fundamental technical and common sense perspectives. So the screening process is precisely the same, whether we're using covered call writing or selling cash secured puts. Exactly the same. One watch list can be used for both strategies. Probably a lot of strategies, but I'm honing in on these two. Now remember, in the BCI methodology, we only use the out-of-the-money cash secured put strike. Now, let me just throw this in. There is one exception to that, and that is if you want to own the stock like yesterday in your portfolio at a lower cost basis, you might use the in-the-money put. But for traditional put selling and for this multi-tiered option selling strategy that I'm talking about today, it's only out of the money puts. Okay, so puts, it's out of the money is lower. So we're going to use the 72.50 strike. We're going to assume a premium of $2 for a 1-month expiration. And that's typical. More volatile security, you get a higher premium. And for less volatile security, you would get a lower premium. Now, our broker is going to get a little nervous now because we're agreeing to buy 100 shares of BCI at $72.50. That's $7,250. Our broker is going to go, well, I don't know if Alan can really afford to do that. So they're going to say, I want you to put the cash into your account to buy 100 shares per contract at $72.50. But I'm going to cut you a little slack. And I'm going to allow you to apply that $200 put premium to that $72.50. So all you really require to put in is $7,050. That becomes the cash secured aspect of selling cash secured puts. That is our investment. That is our cost basis, 7050 in this hypothetical trade. And that's how much we have to put into the cash account per put contract that we sell. Now, we are generating $200 per contract. That's ours to keep no matter what. Now, we also have a contract obligation, and that's to buy 100 shares per contract at $72.50. Should the option buyer decide to exercise the options? Well, when will the option buyer decide to exercise and sell their shares for us at 72.50 when the price drops below 72.50, right? If it's trading at 73, 74, or if it stays at 75, they're not going to sell their shares to us at 72.50. It's got to drop lower. So exercise will occur if the price of the stock drops from current market value of 75 to below that 72.50 strike, even by a penny or more, and we take no action, the shares will be put to us on the Saturday after expiration Friday. Okay, so all of a sudden we own these shares and all of a sudden the cash is gone. So let's assume now that what does our initial trade structuring tell us? Well, we have a premium of 200 on an investment of 70.50, 2.8%. And that annualizes out to 34%. You will find that the returns on calls and puts are pretty similar. The advantage of covered call writing over selling cash secured puts is that if we have the opportunity to use an out of the money covered call, we also create the opportunity for that second income stream on share appreciation from current market value up to the out of the money call strike. Now back to puts. So at the end of the contract, there are two major possible outcomes, assuming no exit strategies. So if the price of the stock remains above the strike price, the option buyer is not going to exercise, period. And the option expires worthless. We have our return. And now the cash is freed up to secure another put on the next contract month. So 2.8% 1 month return. And so that is like your typical put trade there. Now, if you use a less volatile security, a blue chip stock, utility, you're not going to get this kind of return. I'm talking about growth type companies, but growth type companies that have elite fundamentals, elite technicals, that have been great performers, the kind that the institutional investors love. Second possible major outcome is that BCI does in fact move below that 72.50 strike. Right now, if we take no action, expiration Friday passes, those shares will then be put to us that next day on Saturday. And the cash that we deposited, that 70.50 per contract, is going to be used to purchase those shares. Now, at that point in time, we have to take off our hat as an option seller and put on our hat as a share owner. What do we do? Well, there are three paths that we could take. The first one, as you can see on the bullets at the bottom, we could sell the stock. Now, if the price of the stock is above 70.50, our break even, we have then a capital gain. If it's below 70.50, we have a capital loss. We can hold the stock for the long term. Okay, get your coffee out, sit back, and hear me out on this one. I want to move away for a moment from option trading and talk about what I mentioned earlier, using selling cash secured puts instead of limit orders when we want to buy a stock at a discount. All right, so at this particular case, we now have the stock at a discounted price from when we entered the trade. Remember, we entered the trade when it was at 75, and we bought the shares at a break even of 70.50. Now we then own the shares at a discounted price from when the trade was entered. So let's say, going back to the beginning of our trade, we like BCI and we're not thinking about selling puts or calls. We just want to buy the stock. So we say to our broker, if BCI drops from 75 to 71, buy me 100 shares. Here's $7,100. I'm putting it in my cash account. If it drops to that price, I'm in. Now, one of two things is going to happen. It does, in fact, drop below 71. We own the shares and everything worked out fine. Or it doesn't reach 71. It stays above 71. And that $7,100 we put in the cash account did absolutely nothing for us that month. A waste of time, a waste of money. Or we could sell the 7250 cash secured puts for $2, and one of two things is going to happen. Either we're going to buy the stock at our target price, in this case slightly less than 71, or we get paid 2.8% for 1 month not to buy the stock. Those are the only two outcomes. So for those of us that use limit orders when we want to buy a security, you may want to sell cash secured puts instead of setting those limit orders. The one caveat I want to make you aware of is that you must be willing to purchase the shares in 100 share increments, because one option contract is the equivalent of 100 shares. That's the only caveat. The third thing we could do once the shares are put to us is we could then write a covered call, keeping that income generation going. And that's what we're talking about today with this PCP strategy. Selling a cash secured put, and if the shares are put to us, then writing a covered call. So what are our goals? Well, obviously, to make money, to make more money than a risk-free investment like treasuries. Otherwise, why the heck bother, right? Or to even make more money than you can generate by buying an index fund, you know, a low risk, broad market index fund like on the S&P 500. We have to beat that, otherwise why bother? And I'm here to tell you that I've done that for more than 2 decades now, every single year, beating the S&P every year. So our goal is to make money, and to make more money than risk-free and using index funds. You know, money is the highlight of the reason why we're doing these strategies. But we don't want to get greedy, because these strategies, if I could use a baseball analogy, we're never going to hit a grand slam home run. You know, you're not going to be in the casino, pull the slot machine and win $10,000. That's not happening. But you're going to be hitting singles and doubles all day long. And that adds up. And then you compound that and it adds up even more. So we're going to start out by selling out of the money puts. And we understand they may be assigned and the shares may be put to us. And then we can then write a covered call. And if those options are exercised and the shares are sold, we can then use that cash to then secure another put. So ladies and gentlemen, this is a graphic representation of the strategy where we start by selling an out of the money cash secured put. Now, if that's not exercised, then the shares are freed, the cash is freed up to secure another put. If that's not exercised, same thing. Now, if it is exercised, the shares are put to us and we then buy the stock at a discount. Now we own the shares. What do? We write a covered call. And we then are obligated to sell our shares at the strike price. If that's not exercised, we write another covered call. When it is exercised, then the shares are sold and the cash is then used to secure another put. And on it goes. So generate cash flow, buy stock at a discount, generate cash flow, secure another put. And so it goes. And this is the PCP strategy in a nutshell in this one graphic here. Now we're going to turn to a real life example, and keep in mind these are 5-week returns. So in your mind, if you want to annualize what I'm talking about now, just multiply by 10 and you'll have this annualized. Now, at the time that I made this screenshot and initiated these trades in my portfolio, we're going to use one contract because it's just easier, but the percentages will be exactly the same, whether it's 1 or 10 contracts. And at the time, T-Mobile, TMUS trading on the NASDAQ exchange, was trading at 86.09. Now, when we look at the option chain for T-Mobile, and we're selling a cash secured put, we know we're going out of the money, which in the case of puts is lower than current market value. So we're going to kind of hone in on that 82.50 out of the money strike price, lower than current market value. Now, the reason I selected this particular strike for this presentation is that there's a very wide variance between the bid and the ask price. And I'm going to show you how to negotiate with the market maker to get a better price. because we can do that. We can, I mean, if the bid-ask spread is significant, more than 10 cents, we could frequently negotiate a better price with the market maker. And I'll show you that coming up. So in any case, we sell at the bid, the lower, buy at the ask, the higher. The difference is called the spread, the bid-ask spread. The bigger the spread, the more money the market maker makes. So they want to keep the spread as wide as possible. We want to leverage that to our benefit and get the best price possible. But 291 is the published bid, worst case scenario price that we would get for selling that particular strike. Now, before we get into the actual calculations, I just want to stop for a second and show you how to negotiate with the market maker. And this is known as the show or fill rule that we could leverage. It's an SEC rule that geared to retail investors that we could leverage to get better prices when we buy and sell our options. Right now, we're talking about the sell side. It has fancy names, the limit order display rule or the Exchange Act Rule 11 EC 1-4. Big deal. We'll call it the show or fill rule. That's what's important to us. So what that rule says is that if we place a limit order that improves the market, which just means anywhere between the bid and the ask, the market maker must do one of two things. Either execute the trade at the limit order that we submitted or publish that particular price, thereby making the spread tighter. They don't like to do that. So for our couple of contracts, frequently they will give us the better price that we asked for. Once again, any order placed between the bid and the ask will improve the market. So let's look at this specific example with T-Mobile, where the spread was 291 to 610. Now, the first thing we do when we're figuring out what limit order to put in is to locate the midpoint. In the case of 291 to 610, it's 450. That's also called the mark. If you ever see that term, it just means the midpoint between the bid and the ask. Now, we don't just put in a market order, we put in a limit order at $4. That's, you know, it could be anywhere between 295 and 445. What I do is I find the midpoint and I just slightly go in favor of the market maker, because I find that when I do that, more frequently than not, I will get my price. So try not to get too greedy. 450 is a lot better than 291. Now, if accepted, that means we generated an additional $109 per contract. You'll be surprised how frequently you will get the increased value, because the market maker does not want that spread to go from 291 to 610 down to 291 to $4. So if we're putting in one contract, up to 10, you know, the lower amount, the more likely we'll get our price. You know, then they'll just, let me get rid of Alan. Let me just get rid of him and give him his $4. You know, and then I say, thank you very much. It's another $109 per contract. I got money for dinner out on Saturday night. So that's how you do it. Now, one final thing. If you're going to leverage the show or fill rule, there will probably be a box in your brokerage trading form that will say either all or none or AON. Do not check that box, because if you do check the box, then the market maker is no longer beholden to the show or fill rule, and they can just say no. Now, if they say no, the worst case scenario is that we have that 291, or you could try it again. You know, you go to the mark between 291 and $4 and go a little lower, try it again. But worst case scenario is 291. That's what we're going to use. So here's a spreadsheet created by the blue collar investor. Barry and I love doing these spreadsheets. And you fill in the information in the white cells at the top, and you could see that the price of the stock when we started the trade was 86.09. And you could see that we sold the out of the money 82.50 put using worst case scenario 291. That's assuming we couldn't negotiate a better price. Now, once those white cells are filled in, then the yellow or gold cells will then become populated. So let's take a look now at the possibilities. Okay, so the red arrow represents the unexercised return. So if T-Mobile does not move from 86.09 to below the 82.50 strike, that 291 will represent a 3.66% 38-day return that annualizes out to 35%. This is a 5-week return. Okay, now the other possibility is that T-Mobile does in fact move from 86.09 to below that 82.50 strike. So if that happens, what is our break even? It's 79.59, 82.50 minus the 291. So our break even is 79.59, and the blue line that you see in the screenshot represents the amount that T-Mobile was discounted from the original 86.09 to the break-even price of 79.59, 7.55%. So here are the two possibilities when we enter the trade. We either generate a 3.66% 5-week return, or we buy T-Mobile at a discounted price by 7.55%. That's the discount that we receive. Those are the only two possibilities. Now, I told you that we're not going to get into exit strategies because it's beyond the scope of this presentation. But I would like to mention, because we've been going for almost an hour already. Hope you guys are still with me. Probably have another 15 minutes to go. Let me just mention some of the exit strategies for put selling. The actual specific details of these are in the material I'll show you in the last 3 or 4 minutes of this webinar. We have a guideline called the 3% guideline if the price of the stock is dropping below more than 3% below the strike sold, which remember was already way below the current market value of the stock. We have trading outline for what to do if the price gaps down. And most of the time gap down is due an earnings report, and we're avoiding those. So it would be some unusual bad news coming out. Doesn't happen often, but it can happen. What do you do? What if the price of the stock goes to the moon? So unexpected good news comes out. What do you do then? Well, there's ways of making more than a maximum return. And that's using the 20%, 10% guidelines for put selling, which is different than the 20%, 10% guidelines we use for covered call writing. So we have a exit strategy for the situation when the price of the stock skyrockets. We can also roll our in the money option, which means buy back the near month and sell the an option in the next month or next week. And if the put option is out of the money at expiration, you don't have to do anything. It'll just basically expire worthless. So no action is needed then. All right, now let's move on to the call leg of the trade. Remember, we purchased T-Mobile at a break even of 79.59. Now for covered call writing, we have the opportunity to sell an out of the money strike higher than current market value, OTM on the screenshot. Or if the chart was mixed, we're concerned about the overall market, we would lean towards an in the money strike lower than current market value. We're going to show you both on this spreadsheet. So let's start out with the out of the money. So it's the second column that's filled in from the right, where we sell the out of the money higher than current market value 82.50 strike. And you could see in the screenshot here that that generated a premium of $2.30, $230 for the one contract. Now, once those cells are populated, then the green cells below will get filled in. So we're going to look now at the purple arrows for the two possibilities here. If the initial option, the 230 divided by 79.59, our cost basis, represents a 2.90% initial time value return on a 32-day trade, which represents a 33% annualized return. Now, we also have upside potential, the lower of the two purple arrows, of 3.7%. What that means is there's an opportunity to generate an additional 3.7% in those 32 days if T-Mobile moves from 79.59 up to that 82.50 strike. So there's an opportunity here for a 6.6% 32-day return with this particular trade. And that would be the advantage of the out of the money strike here, is because you can get those two income streams. Now, what about the in the money strike? Well, the in the money strike would be, an example would be the 77.50. Remember, our break even is 79.59. So in the money for calls is lower than current market value. 77.50 generated a 4.425 return, $4.25. Is that all profit? No, because we're going to be losing $2.09 on the sale of the stock because we own it at 79.59. We're agreeing to sell it at 77.50. So the calculator will automatically deduct that 209 when calculating the initial time value return. And you can see from the top green arrow that after that 209 is deducted, that represents a 2.8% 32-day trade, and that annualizes out, you can see down here, to 32%. You can see once again, the calls and the puts pretty similar. Now, what if the price of the stock goes up? Well, too bad, because we're agreeing to sell it at a lower price than it's currently trading for. And that is the disadvantage of selling in the money call options. You have no opportunity for share appreciation. But what if that chart was mixed? And what if you're worried about the market and you want additional downside protection? Well, what you could do is sell that in the money call, which has, let me get my cursor here, it has an intrinsic value component of 209. You can see no intrinsic value component on the out of the money side. So that lowers our break even by another 2.6%. In other words, T-Mobile can drop by 2.6%, and we still will have generated that 2.8% time value profit. So when we're looking for additional downside protection, covered call writing, we use the in the money strike. Now, that 2.6% is to guarantee that 2.8% time value return. It does not tell you how far down it is to break even. The amount to break even is 5.2%, right? If it goes all the way down to the break even point of which we have at 75.34. This calculator will give you all that information. So you can see that there's a huge distance when we entered that covered call trade by 5.2% to the break-even price point. And the reason that I'm bringing that up is because, remember now, this is the second part of a PCP strategy. We already had protection on the put side, and now we have additional protection on the call side. So if we want that maximum protection when we sell the covered call, we're going to use the in the money call strike. So let's take a look now at the strategy as a whole, as a multi-tiered option selling strategy. The PCP in its entirety, in that 2-month time frame, we have downside protection of 12.75%. 7.5% you could see on the left side of the screenshot was the discounted purchase price from selling the out of the money cash secured put, and then another 5.2% to break even by selling the in the money call option. So just think about this. Over a 2-month time frame, T-Mobile can drop by 12.75%, and we haven't lost a penny. If it drops by 10%, we made money. So that is the advantage of mastering both strategies, selling cash secured puts and covered call writing, because you can integrate it into one multi-tiered option selling strategy that will give us tremendous downside protection. Now, that doesn't mean that each leg of the trade, you shouldn't manage your positions. You should. And that's going to make your returns go even higher. So, there's a little bit of work that needs to be done, and it starts with mastering those 3 required skills. Now, there are exit strategy opportunities for covered call writing. Those of you that are members of the Blue Collar Investor, you may be sick of hearing me talk about it, but you must know how to manage your trades. We have 20%, 10% guidelines for calls. It protects us when the price goes down. For puts, it gives us opportunities when the price goes up. We could roll down, buy back the current strike, and roll down to a lower strike price, which will generate additional time value to our cash account. The price of the stock goes to the moon, we could close the entire trade at a time value cost approaching 0 and start up a second income stream. If the stock is just not performing well, we have to be brave, bite the bullet, close the trade in its entirety, and take the cash to enter a new trade with a different security. Sometimes you just have to do that. And one of the hardest things for retail investors to do is to realize that, hey, I've screened the heck out of this stock. It's not performing the way I needed it to. And so I'm just going to get out now. So we give certain guidelines for that as well. Hitting a double, it's a baseball analogy where we buy back the option at a low price when stock price goes down. And then if it recovers, we resell the same option. If you can just envision a chart pattern shaped like a V. So you sell it at the left side of the V on the top, you buy back the option at the bottom of the V, and then you resell the same option on the right side leg of that V as the price recovers. You'll be surprised how many times you can hit a double if you're prepared. And also rolling the option, if the strike is in the money, stock price higher than the strike price, as expiration is approaching, you can buy back that near month option and roll it out to the next month's option, or roll it out and up to the next month's option, higher strike price. So a lot of opportunities. We have to be prepared and be ready to take advantage when those opportunities do arise. Let me summarize. Then we'll get into that package for 3 or 4 minutes, and then check back in with Barry if there are any remaining questions. So what are we looking to do here? Money. We're looking to generate monthly cash flow in a low risk manner. We're not going to get greedy. We're not looking to hit a grand slam home run. We want to hit singles and doubles all over the place. We're going to start by selling out of the money cash secured puts with strikes lower than current market value, seeking to have a monthly return of fill in the blank. In my case, it's 2 to 4% a month for my initial trade structuring. I trade more conservatively in my mother's account, where I use ETFs and look for returns of 1 to 2% a month. Lower risk securities meets the needs of my mom. I'm still conservative, but just not quite as conservative as when I trade in her account. Now we manage with exit strategies when those opportunities arise. Now, if on exercise, we sell another cash secured put, generate more income for the next month. And when it is exercise, we then own the shares. We write a covered call in the money to take a defensive approach, out of the money to take a more aggressive approach, depending on chart technicals and overall market assessment, as well as our personal risk tolerance. Not the same for everybody. We manage the covered call aspect of the trade with exit strategies when those opportunities arise. If on exercise, we write another covered call, make sure we avoid earnings reports. And if exercised and the shares are sold, we use that cash to then secure another cash secured put. Now, once again, this is a graphic of the PCP strategy. A picture is worth 1,000 words. So this is actually the image on the back of my book, Selling Cash Secured Puts. Success is based on education. You guys, you guys know that, or you wouldn't be here today. So once again, appreciate your attending this presentation. That's where it starts. And those beginning, you need about 3 to 4 months to educate yourself, practice a little bit, and then you've got years and decades to benefit from these great strategies. I'm going to talk to you for about 3 minutes on our best and most comprehensive investment package. I'm going to be giving you another $100 discount coupon in just a moment. And that's what we call the BCI package, which is an acronym for best and most comprehensive investment package ever offered by the blue collar investor. It has a ton of stuff in it. I'm just going to give you an overview, and then you could go to the link and see it in more detail. You're going to get an annual premium membership, which is 13 months, which includes the reports. I'll show you that in a second. 6 online video courses with downloadable workbooks, 5 of our best calculators and spreadsheets, 5 of our best-selling books in ebook format, and I've held that slot on Amazon. Best-selling option books now for 14 years. You're going to get buying all this in one package gives you a discount of 20% or $247 before the additional $100 I'm going to tell you about in a second. And just go to our website, thebluecollarinvestor.com. You see that red arrow? Click on that, and you'll be able to watch a video and see the information I'm giving you now in greater detail before you make a decision. Now, the premium membership consists of 2 weekly reports, a stock report, which you're seeing on the right side of the screenshot, and an exchange traded fund report, which we give you midweek. It also includes a monthly blue chip report on the best performing Dow 30 stocks, and then a quarterly report on dividend capture. Also includes a huge educational component of 200 videos. We add a new one every month, some months more than one more video, plus additional about 24 files and other trading resources. Now, there's actually 6 online video courses. You see them listed on the left side. And once again, those also have downloadable workbooks. So you could print those out and use those workbooks along with the video courses. We have developed calculators and spreadsheets for these, for all of these strategies. You can only find them at the Blue Collar Investor because we developed them. Our best one is the Elite Plus calculator, which was just recently developed for both covered call writing and selling cash secured puts. But we also have calculators specific for related strategies like the poor man's covered call. We have a trade planner for setting up your goals and exit plans. We also have a stock repair calculator, which is not really options, but what if you have a stock that's dropped in value and you want to lower your break even? A lot of times investors will buy more shares at the lower price, called averaging down, but we're going to show you how to use options to lower your break even without adding more money to the trade. You can use the stock repair calculator for that. Our 5 of our best-selling books in ebook format, you can see them listed on the left side. The screenshot you're seeing now, the Complete Encyclopedia for Covered Call Writing Classic Edition, has been the #1 selling book on covered call writing on Amazon.com since 2014. Now, for the Research Triangle group, we're going to be giving you an additional $100 discount using the promo code Triangle100. Pretty simple. Just put that into the promo code box and another $100 will be deducted. I don't know if I mentioned the total package is $997, which is a discount of over $240. And then with the $100 will be additional total discount of $343. So the $897. And this code is active today and tomorrow. So if you go to that link, you can get more information plus a video that I created. Once again, thebluecollarinvestor.com. Just click on that link and you'll have the information and a video if you're looking for more information to make a decision on whether or not this package is right for you. So ladies and gentlemen, that ends my presentation today. If you have any questions that were unanswered or you think of later, you can email Barry at thebluecollarinvestor.com or me, Alan, A-L-A-N, at thebluecollarinvestor.com. And we will get back to you the same day or the next day. We're pretty good at answering all of our emails. I want to thank the Research Triangle Investment chapter of AAII for inviting me to speak. It's always an honor. I want to thank everybody for coming. I'll check in with Barry now. Any questions, Barry, that are left over or did you work your magic again?
No, we're pretty good. We covered every question, and I was providing some color commentary throughout as well. There have been about 40 questions we answered, so we did pretty well.
Okay, great. Okay, so gentlemen, I want to thank you very, very much for inviting me. Thank everybody for attending. And I look forward to seeing or hearing from you at some time in the future. Take care, everybody.
Alan, thank you very much. I do appreciate that. Well done and impressive. I have one comment and then David has a comment. Our next speaker will be Amy Smith. She works for Investors Business Daily, and she will be with us on May the 8th at 10 a.m. David?
Yes, Barry, if I could ask you to stop sharing your screen, I'd like to share a couple things on our website. Let's see if I can find it here. Oh, not that one. Well, let me just go to our website. So our chapter website is AAII RTP.org. Are you guys seeing that?
Now, what you got up is Alan's presentation.
Right. On our website, correct?
Yes.
Okay. So we have updated our chapter information web page. So if you go over here to chapter information, you'll see that we have some contact information. This is also where we tell you where we meet when we resume in-person meetings. If you would like to volunteer for a position, you can contact me at president@AAIIRTP.org. That will forward it to my email address, or you can send it to the whole board at info.AAIIRTP.org. We're looking for a vice president and librarian and a couple of other positions, marketer and videographer. So if you can help out with those as we plan to meet in person again, that would be very helpful. I did also want to share something about on AAII.com. If you go to the AAII.com website, Alan wrote an article for the journal back in 2015. So if you go to the AAII.com website and then search up here for Alan Ellman. Yep. Didn't work that time. There it is, Alan Ellman. You can then find his article from 2015. Okay. And you do have to be a member to access that. Okay, I think that's all I have. Carl, anything else you'd like to say?
Nope, that is it. Again, Alan, Barry, thank you very much. And we'll see the other folks on May the 8th. Have a good day.
Thank you all for attending.